Hi folks, this is time to look at the market once again. We are going to do our weekly review. It would be the 15th edition of our market outlook, stock reviews, stock recommendations, including the indices. We would do Nifty, Bank-Nifty, CNX MidCap, sectoral indices, reviewing stocks, as well as 2 recommendations. If we would look at the Nifty, look at the Bank-Nifty, the CNX MidCap, even sectoral indices. We would look at Nifty with moving averages, Bollinger Bands. This week, the Nifty was mostly maintaining below the 20-day and 9-day exponential moving average. We are going to discuss the 125-minute chart of the Nifty. In the 125-minute chart, what we see is that there is a clear distribution pattern. Image that you see, especially look at from the July till say mid of August, the kind of movement that has been seen, especially see the green, a light green zone in which the most of the trading has happened. This suggests that the Nifty is clearly on a distribution mode. Distribution has been happening for the last 1 month. When we go to the weekly chart, you will see that there are 3 successive red candles. That means for the last 3 weeks, Nifty has been opening higher and closing lower. So either this could be the onset of a correction or it is a minor correction. If the recovery attempt is substantial, if there is a much higher close from the last close of 19,424 kind of, that is the real-time close, at least you need a close next week above 19,800. Unless that happens, this distribution pattern will continue and there would be more weakness. Now what you see is the daily chart. In this daily chart, what you get is that last 8 candles, that means last 8 trading sessions had happened below the 20-day exponential moving average, and last 7 trading sessions had been, we saw close below the 9-day exponential moving average, and on the last day, that is on Friday, the closing level was very close to the lower Bollinger Band. This suggests that the weakness is pretty much pronounced. Now what we need to see is the 50-day EMA. That is the 50-day EMA currently, as you can see on the chart, it is located at 19,242. So if 19,242 or rather 19,200 level gets broken, this downtrend will get more strength and the bears will have much greater control. It would be a longer lasting correction. Finally, what you see now on the screen is the weekly chart, weekly end of day chart on Friday, 11th of August. Here you can clearly see that 3 red candles in succession. This has never happened over the last 4 months. Only in April or late March we have seen similar things. Now the 9-week moving average, 9-week moving average is located at 19,281. So a little earlier we referred to the 50-day moving average at 19,242 and this 9-week moving average as 19,281. So this range between 19,281 and 19,242 would act as critical support level. If 19,200 gets taken out, then you can expect we are heading towards the 20-week moving average. 20-week moving average is located at 18,628, but that is much lower levels. suffice it to say that at the moment we need to watch out if 9 week is decisively broken or not. Expect bears have greater control over the current situation, unless, of course, as I said, that if there is a huge rally during this week and that takes the Nifty beyond 19,800, then only this correction would be considered over, otherwise weakness continues. Even the foregoing week, Bank Nifty was the index that tasted the 50-day moving average, continues to show weakness, while its senior brethren Nifty was not that weak. But Bank Nifty was being sold and banks were being sold in a big way. In some cases, they showed considerable weakness. We are going to study that in detail and we are going to review bank stocks as well. Bank Nifty 125-minute chart we begin with. Look at the 125-minute chart on your screen. What you can see is that the 200-unit exponential moving average that has been tasted over the last 3 125-minute sessions. That means on last Friday, you can see that the 125-minute chart shows that the 200-unit EMA, the close of 3 125-minute candles had been below that. This signifies a major weakness. It is harbinger of a major weakness. During this week, this 200-unit exponential moving average on the 125-minute chart was tasted on 3rd of August. On 3rd of August, Thursday, it was tested, but it was not breached. It acted as a support. Then it moved up. This particular movement, that is the first test of the 200-unit moving average, and thereafter the recovery attempt. First, the recovery attempt was getting foiled at 9-unit moving average, and later on it was both 9 and 20 which resisted any movement beyond that. This signifies that it could be actually a problematic thing for Bank Nifty. It looks pretty weak. Now we come to the Bank Nifty YTD chart. YTD chart shows 3 successive red candles, and Bank Nifty has not just moved below the 9-day moving average. Bank Nifty has fallen below the 20-day as well as the 50-day moving averages. Of course, we have seen the same happening in the month of June, but that time the 50-day moving average was not even tasted. But this time the 50-day has been tasted in the last 7 sessions 4 times, and it has closed below that on Thursday as well as Friday. This is a much clearer weak sign. Now, what you need to observe here is this: just as on any movement on the upside, the 9-day moving average, 9-day EMA supports the price movement. It has already started happening for the Bank Nifty that the 9-day EMA is now resisting it. And the fact that there was a bearish crossover last week between 9 and 20, this week we see that Friday just fell short of a bearish crossover. If Monday's session is also negative, then we can see that even this bearish crossover between 9 and 50-day EMA will also happen. In that case, Bank Nifty is headed lower. Where it is headed? It is headed initially, it is headed to say 44,000 kind of levels. After that, once it falls below 43,750, then there is a possibility that we are headed for 43,500 to about 43,400, that kind of range. This range, 44,000 to about 43,300, this is likely to act as a support for Bank Nifty, because during the month of May and June, part June, part May, it supported the Bank Nifty, or rather there had been a lot of trading within this range. Now we go to the Bank-Nifty Weekly chart. Bank-Nifty Weekly chart shows again the similar three successive red candles. 9-week moving average has been taken out. 20-week moving average is about to be taken out. 20-week moving average is currently at 43,708. If 43,708 is taken out, that means roughly 43,700 gets taken out, then the next support that you can expect will be around the level of 42,700. 42,700 is the zone that will be a very critical support level for the Bank Nifty. But first, as we saw in the daily chart, that 44,000 to about 43,300 would be a support area. Once that gets taken out, then we can think of that the Bank Nifty would be headed for sub 43,000 levels. In any case, if there were to be any major selling, then 42,700 would act as a strong support area. CNX MidCap, on the back of huge amount of SIPs, record amount of SIPs, and mostly that going into mid caps, and retail people are still pouring in money. So CNX MidCap100 continues to show strength, is still going up. We are going to do a thorough study of it along with other sectoral indices. As we have been mentioning, and you have seen on the charts that also during the market hours, that CNX MidCap is one index that has been cruising on the upside, and it was hardly showing any kind of weakness, or whatever weakness that we saw, that was mostly confined to the intraday corrections. There had been 2 days in between when CNX MidCap closed lower. Otherwise, it continues to be strong up move. If you look at the 125-minute chart, especially for the last week, then what you see is that over the last 2 daily sessions, that is Thursday and Friday, that would mean the last 6 candles of the CNX MidCap100 chart, and that they were pretty weak. And they were all red candles, and the 20-unit moving average on the CNX MidCap is now being tested. Of course, it is being tested, but it has not been broken, or rather the test is also, we would say that it is a feeble test. So unless CNX MidCap falls below 20-unit moving average on the 125-minute chart on a sustained basis meaning at least you would see 3 successive days, or 9 successive red candles, or the movement of the price activity of CNX MidCap is below for 9 125-minute candles, then we would say that CNX MidCap is weakening. This is one citadel that the bulls are still holding on to. Look at the YTD chart and the Gann angles and 20-day moving average. 20-day moving average is actually the moving average just below the supporting Gann angle. So the supporting Gann angle has been tested and breached once, but the 20-day moving average for the CNX MidCap has not been tested for the last 4 months that we have been mentioning. So you can still see that despite the fact that the last couple of days had been pretty weak sessions, especially last Friday sessions had been quite weak, but we have seen similar weak session on 2nd of August, Wednesday as well. Yet the CNX MidCap jumped. But now we need to see whether this time it goes below the 20 unit moving average. Prior to that, it should go below the 9-day exponential moving average and the Gann angle there. The Gann angle on Monday would be on 37,875. That level would be a very critical level if it were to fall, because the Gann angle is upsloping, and this value of 37,875, this would be the lowest value of the Gann angle next week. So 37,875 definitely assumes a strong significance. So just as the 9-day exponential moving average value of 37,776. So 37,875 to about 37,775 is the support area. Unless this gets taken out decisively, don't expect that CNX MidCap would be weak. Finally, we look at the weekly chart of CNX MidCap100. Weekly chart shows that despite a steep climb on the upside since early April, there had been only 1 week when the CNX MidCap, this was the June 19 week starting June 19, that week it closed lower, but otherwise it has been showing green candles. Though there is a gravestone doji on the last candle, that signifies that there could be some weakness, as we have observed in 125-minute as well as the daily chart. So unless we find that at least the 9-week exponential moving average, which is located at 36,400, that gets taken out decisively, there is no major threat to CNX MidCap100. This week, among the CNX sectoral indices, we review the CNX Public Sector Enterprise, CNX PSE Index. CNX PSE Index on the daily chart, we see that it is maintaining above the 9-day exponential moving average. It has not tested, just as the 20-day moving average. This one also doesn't test the 9-day moving average. Might have been tested, but 20-day moving average is not tested. And it is upsloping, it is moving up. One day it tried to go beyond the Bollinger Band, and then on the third day there was a big fall, but the big fall was supported ably by the 9-day exponential moving average. In fact, over the last full week, 9-day exponential moving average was supporting the CNX PSE. So CNX PSE continues in its upswing, and we would say that the resistance level would be 5,500 to about 5,525, and the support area for this index would be 5350 to about 53,300. The 20-day exponential moving average is located at 5,339. So 5,300 is a major support area, and 5,500 is a strong resistance zone for CNX PSE. Our second sectoral index chart will be CNX Realty. A CNX Realty chart, you can see on the screen, the Bollinger Band is there, and the 3 moving averages that we normally use, that is also there. What we find is that after say middle of April, when it took out 200 exponential moving average, CNX Realty has been moving up until late July. Early August it started sliding, and once it started sliding, in 3 days it actually broke both the 9-day as well as the 20-day EMA. After the EMAs were broken, movement of the CNX Realty could not really take out neither the 20-day nor the 9-day exponential moving average. Last 3 trading sessions had been below both the indices, and not just that, there is a bearish crossover of 9-day and 20-day exponential moving average. Wednesday, Thursday and Friday, all 3 days we have seen that the index was actually trading in a very weak fashion. Now on the weekly chart, there is a bearish engulfing pattern last week, and this week also there is a black candle, and the 9-week exponential moving average is likely to be tested as well. So this has faced a speed breaker. We would be reviewing the DLF chart as well, so you will get an understanding as to how one of the lead counters in the sector is performing. Our last and third sectoral indices is CNX Small Cap Index. CNX Small Cap Index we are reviewing for the first time, and we are using the YTD chart. In this YTD chart, you can see that from late March, the move on the upside, it was a major move, although there had been red candles in between, but there had been very few tests of the 9-day exponential moving average. Once it closed below the 9-day exponential moving average, 9-day EMA, on 23rd June, that day the market fell very substantially, and this also closed below the 9-day EMA. But till date, what we see is that even in the last week, when the most of the market, the large caps, the mid caps, the sectoral plays were suffering, this index tested the 9-day exponential moving average only once, and that was on Tuesday. The last couple of days had been red candles, there are bearish candles, yet we see that the 9-day EMA at 10,678 has not been tested. This is the major reason. The major reason for this kind of an upsurge is that retail is still pouring in money. Retail investors are still pouring in money, and they are chasing small cap stocks. Although while the index looks pretty healthy, but the development is not. When retail chases small caps in this fashion for say 4 consecutive months, when the market goes down further, and the bearish sentiment becomes much stronger, then this small cap index might actually give a sharp fall, as you have seen on the chart. In late 2022 this happened. This can happen in this time also. So be very careful about chasing small cap stocks, and lots of weak hands would be buying into these small caps to make quick gains, although that has been the case over the last 4 months, but it may not be so going forward. If you liked my presentation, press the like button, subscribe to my channel, share it among others, and also don't forget to press the bell button so that you get all the recommendations and notifications from YouTube. This time we are going to do at least 3 stocks under review. There will be a real estate stock, there will be a banking stock, and we would choose the third stock. Just wait and see what is in store for review. You can see one thing in DLF. This looks very much like the Bank-Nifty chart 2 months back. The Bank-Nifty chart was also showing this projectile formation, and you have seen what has happened to Bank-Nifty. It isn't as if that the same thing would be repeated out here, but the DLF looks pretty weak, and it is already testing the 50-day exponential moving average, and the 50 EMA is now located at 482.91, and 482 is the closing of last Friday. So that means it has just been broken. Now, what is the import of this? Look at the 14 RSI. 14 RSI, after posting a top around say mid-May, 14 RSI top happened at the level of 81.11. After that happened, 14 RSI has been on a steady negative divergence, and this negative divergence has been continuing over a period of last 3 months. Now is the time perhaps that DLF is going to break down on the, it is headed for lower levels. Of course, even the 50-day EMA, this is not the first test. 50-day EMA was tested last month on 25th of July. So there is a definite possibility that if DLF stock falls below the lower Bollinger Band level of 473, then there would be further fall, because the bearish crossover of 9 and 20 DMAs have already happened. 9 and 20 DMA are now they are resisting this, and there is a bearish engulfing pattern on the daily chart, which is not just encompassing or engulfing the previous day's trading. It is actually engulfing last 4 days. That means Monday through Thursday, whatever had been the open and the low range, that was encapsulated on Friday. This is a pretty bearish sign, and DLF is headed lower after it breaks down the levels of 473, 474 being the last critical low, and thereafter the next support comes at 466. 473 to 466 range, if taken out, then there would be a definite possibility of a taste of the 200-day exponential moving average around 427. DLF in all likelihood is actually getting ready for sustained course correction. This could be an intermediate downtrend, not just a short-term downtrend. Short-term downtrend, it is already there. The weekly chart of DLF also corroborates that. There is a bearish engulfing pattern at the top. Last week meaning the week before last, this Friday, DLF actually broke down the 9-week exponential moving average that was located at 486. So DLF is conclusively looking weak, and it is headed lower. 20-week moving average, which is now located at 458, that would be another support level. So 473, 466 and 458 are initially the levels to watch out for. After that, the 200-day exponential moving average of 427 might also be tasted in the intermediate downtrend. Our second review stock is Naukri or InfoEdge. You can see one thing, that Naukri was posting a new high. That was 4984 high, the yearly high for Naukri, Monday 7th of August. And from there, it fell below the 9-day exponential moving average, 20-day EMA, and finally it closed a tad above, or rather 1%, only 1% above the 50-day EMA. This is definitely a sign of weakness, no doubt about it, because it is breaking down. It is breaking down. I have not included this stock as a recommendation for the simple reason that at this point of time, a recommendation that is quickly actable, that would be a sale call. But selling is not warranted in this stock for a very important reason. That is, it has already fallen by more than 10% from the top. Not just that, it is on the 50-day moving average, but the 200-day exponential moving average is also not very far from the current levels. Only about 300 points left. But what I would like to highlight now is, look at this second chart of Naukri. This is the weekly chart. There is also a bearish engulfing pattern, but there is something that you must look at. That is that there is a saucer pattern developing on the weekly chart, and not only that, there is a golden crossover between the 20 week and 50 week moving average. What happens in such situations? When these two moving averages on weekly chart give a golden cross, initially the stock comes down, and the stock this time may come down to even 4,000. But instead of selling it now, wait, keep a close watch, and then get into it for a big run on the upside. For a big run on the upside that will happen. You have to have patience to actually get the full benefit of this kind of a formation for this stock. So Naukri is our review stock. There is no recommendation as of now. It may go down first, but thereafter there would be a sustained upswing. This is a course correction in its intermediate upswing. If you liked my presentation, press the like button. Subscribe to my channel. Share it among others. And also don't forget to press the bell button so that you get all the recommendations and notifications from YouTube. Now we have reached the recommendation stage. The two recommendations. One of them is going to be a chemicals company. What would be the other? Keep watching. The first stock that we have chosen is Page Industries. Yes, it is a 41,000 rupees stock. What I would like to say here is this, that please don't get upset or feel bad about a stock whose share is trading at 41,000. It is just the same as buying a 40 rupee stock, 1,000 shares. Page Industries is a strong blue chip. It has got a major brand. Most of us are familiar with it, Jockey. And Page is a great company. Page is a consistent compounder. As a company, has done brilliantly well. It is a great stock. Now, after forming a major base, and there was an aborted attempt in the month of April and May, but now it has already taken out the 200-day exponential moving average on the daily chart, and a dividend is due very soon. It is about 75 rupees. The dividend, it will become ex-dividend on 18th of August. 75 rupees dividend they are giving. But I'm not talking about the dividend. I'm talking about the possibility of a major upswing developing in Page Industries. What is the prognosis of this? That initially it will need to take out 44,000. 44,000 to precisely speaking, the earlier May high was 43,500, 43,503. Now that needs to be taken out. Once that is taken out, then the next resistance will come at 45,312 or roughly 45,300. But I'm looking at a major rounding bottom formation where the earlier high around 53,000 could be scaled up. You need to be patient with this kind of a stock, and also because it is a very regular pattern, it may take time to reach those levels, but it will. So put a stop loss below 36,000. That is a 10% stop loss. Yes, on the upside there is a possibility of a 30% rise. So it would be a 1:3 risk reward ratio kind of a stock, and I would definitely suggest that you go for it. Now, if you look at the weekly chart, what you find in this is that 3 green candles, and it has already taken out 9-week, 20-week, and 50-week moving averages. So Page is a buy, and put a stop loss below 36,000 on weekly closing price basis. You are not going to not going to be disappointed. Give it time, give it a year or two. It's a long-term bet. It is headed towards the earlier high. 52,000 is our target. Our second and final stock recommendation is a banking stock. It's RBL Bank. RBL Bank, this is a special case. Lots of banking stocks are now showing a lot of weakness, but this is one stock that has been forming a base. On the weekly chart, if you look at it, you will find that it has been forming a base for last 3.5 years. 3.5 years, or at least more than 3 years. And now it is taking out its 20-week moving average. Even though the sentiment currently in the market is weak, yet it is showing signs that it can still move up. Even if it were to come down, that would be your great buying opportunity, because now that the 200-week moving average is being taken out, or it is being tested, it would be taken out, because even the RSI on the weekly chart has posted a higher high. So in that case, what we see now is there is a good buy call with a very affordable stop loss. It is not a trading recommendation. It is actually a long-term buy recommendation. Long-term buy, you should be putting your stop loss below 159 on closing price basis. I am acutely aware that I am giving a 63-point stop loss, but the kind of levels that it could actually go up to, I feel that the first major target would be 295. After that, the next target would be 343, and final target we are keeping at is about 390. So it again, just like Page, it is 1:3 risk reward ratio stock, but from my experience, what I can say is that you can at least expect 500 plus levels over a period of next 2 to 3 years, because this kind of formations always lead to scaling up of earlier highs. So I'm not talking about the ultimate, the maximum high that was close to 700. All I'm saying is you will see more than 500. When you look at the daily chart, it only showed weakness on the last Friday, but going with the market sentiment, it can also come down. So since it is a long-term buy, it's not just 1 year, not just 2 years, you can even hold it for 3 years. In such a situation, you should not be buying at one go. Buy at current levels, buy on the fall, buy up to 200, and then put a stop loss below 159 on closing price basis. Going forward, you will see how RBL Bank pans out, how RBL Bank's price movement pans out. This is a good long-term recommendation. I have done a lot of research, lot of things I have talked about. If you really liked it, that you have spent so much of time with me, YouTube has told that you are spending more time. I'm so very happy. Thank you. Thank you for being with me. Thank you for watching my videos.